Yesterday, remember where and what we covered. We were able to do certain entries, and also we started doing the adjustments where necessary. We left at a point where we were doing computation of goodwill. And I also remember in so doing, I brought another aspect and told you that I would do valuation of the subsidiary at the date of acquisition and also at the date of reporting. And I told you that bringing on board valuation of the subsidiary at the date of reporting, which I used the initials DOF, date of financial statements, this is not part of computation of goodwill. But the reason why I brought it here is so that we can be able to start preliminary preparations for computing NCI and also group retained earnings, which we of course we need in preparing the consolidated statement of financial position. So take note that it's not the usual part of computation of goodwill, but it has a reason. So that informed us to get the post-acquisition profit when we checked the difference. And I remember explaining how that arises and what we usually, what we've done before when preparing published accounts, especially at the statement of changes in equity level. So that post-acquisition profit, we of course shared it between the parent shareholders and the NCI. They share into that profit. They made it together. They made the profit together. So we shared it between them, among them. Then, of course, when we came back to our goodwill, which is the difference between the total purchase consideration, and we compared it with the value or the net assets of the subsidiary at the date of acquisition. So the difference between 42,480 and 25,440, that's where we got our goodwill of 17,040, which of course we went ahead and apportioned. Why did we apportion goodwill? We apportioned goodwill because we will also need the same breakdown when computing our NCI and group retained earnings. So that also forms part of the reasons why we brought on board these sections here. But our goodwill is just the difference between these two. So our goodwill computation could have ended here. So I hope that you have connected to what we did. Now, what we do next, because already we have our goodwill, we know where we need to post it. So why don't we go to our statement of financial position and bring on board this element? I highlighted it in red because it was a computation, but now that we've done it, let me take it back to black. Then I just want to refer to that cell where we have computed our goodwill. So our goodwill, and I told you in some books, you will get it written like unimpaired goodwill. So we know that when we talk about fixed assets, reduction in value is normally depreciation. But when we talk about goodwill, the intangible, now they suffer impairment. They suffer impairment. So that's why in some quarters they call it an impaired goodwill. So if there is impairment, it will reduce the value of goodwill. So let's take note of that. So goodwill impairment will affect the value of goodwill, which of course, remember, we have apportioned the goodwill between the parent and NCI. So in the computation of group retained earnings, if there is goodwill impairment, when you are computing group retained earnings, you will have to deduct the goodwill impairment, the value by which it has reduced, we call it the impairment, you will have to deduct it from the group retained earnings. But again, I remember telling you that in this consolidated statement of financial position, at the section of equity where you have group retained earnings and NCI, because they normally bring problems to students, once you compute one of them, the other one will automatically be the balancing figure. So you do not have to scratch your head so hard, but you need to know how to do the computation. It forms part of the workings and the adjustments. But in an exam, in case you are pushed to a corner, just compute one of them. The other one will balance it out. So we are going to see how that unfolds. So I've already brought on board the goodwill there, the goodwill, which, let me just refer to it again. That was the 17,040. So the goodwill is there. Now, I want us to look at investments, because when we come to the section of group retained earnings and NCI, I would want us to do them the last adjustments. But because we still have some additional information which we've not finished, I would want us to go through them. But as we go through the other additional information, so of course, we will see where we need to do adjustments where necessary. I know the first one, we had checked on it. But we will check again. I remember note 2, we are also done. Note 3, we are yet to work on it. I know note number 6, we had checked on the fair value adjustments and picked the figure. So we are going to see on the other remaining 3 adjustments where possible. But I want us to look at the investments. Now, members, I remember I had mentioned something about investments yesterday, and I would still repeat the same here. So when we talk about investment, group investments, when consolidating this statement, remember, I want us to go to the statement provided for the 3 companies. There is this balance sheets that were given. And under investments, I can go ahead and highlight it Under investments, you realize that we have investments under the parent company. We have investments under the subsidiary. I'm talking about parent and subsidiary because that's where we started. We started by looking at our group structure, and I hope you remember how we did the categorization. Very important. So under the parent, we have investments of 48,000. Under the subsidiary, who is the Solo Limited, we have investments of 10,920. Under the associate, who is Alo Limited, there is investment of 0. But I want to challenge us a bit. When you talk about group investments, you need to ask yourself, who is consolidating? It is the parent. Who is the parent in this case? It is Polo. So if you focus on the 48,000, of course our figures are in millions. If you focus on this 48,000 investment, this should tell you that the parent already has captured the investments that, the parent is the one purchasing. Let me take that route. The parent is the one who is paying to acquire the subsidiary at 90%. And again, it is the same parent who paid to acquire the 30% of this other company called Alo. So those forms part of the group investments because the parent consolidates. So when adjusting for the investments, we need to take care of the amounts that the parent paid, to buy the subsidiary, and the amount the parent paid to also take control of the 30% of this company. So let's go and do the adjustments. And these adjustments, I don't want to put them as a working. I want us to just do them in that one cell, and it will all be good. So we go, and I told you again, when we were consolidating, we were taking 100% ownership, or we were assuming 100% of the parent assets and liabilities, and again, of the subsidiaries' assets and liabilities. But we did not consolidate the associate. We do not. And I remember that's why I highlighted it in red. We do not consolidate this fellow here. This fellow, we just consider our investments in this fellow. Then we ask ourselves, how much did we spend or pay for that fellow? But we do not consolidate. So under investments, let's go to that cell. And what we say is simple. I put an equal sign. Then I pick the investments of the parent. Then onto it, I add the investments for the subsidiary. We are consolidating 100% assets of the subsidiary and 100% liabilities of the subsidiary. So once we pick onto that, the next thing is, as you assume 100% control, you also have to remember that there is some money that you paid. There is some purchase consideration that you gave when acquiring the 90%. So a good practice when looking for these investments to take to this statement, we deduct the amount you paid to acquire the subsidiary. We deduct the amount you paid to acquire the subsidiary. So how much did we pay to acquire the subsidiary? We deduct. So I put a minus there. Then we go and look for it because we already computed it. So how much did we pay to acquire the subsidiary? In the computation of goodwill, we already computed purchase consideration. So how much did we pay? We paid 38,880. And I hope you remember how we arrived at this figure. That is the amount that the parent paid to acquire 90% of the subsidiary. So we take care of it. Then we also ask ourselves, how much did we pay to acquire the associate? How much did we pay to acquire the associate? It is part of the investments of the parent. So in this case, we did not consider, even if this figure was not zero, you see this figure here, even if investments under the associate was not zero, even if it had a figure, please do not just go and add it because we are not consolidating this here. But now we have to ask ourselves, that 30% that we acquired, it is part of our investments. How much did we pay for it? That is part of our investments. So the amount that we paid to acquire that associate, we have to deduct it. Somebody would ask, why are we deducting that amount from our investments figure? The reason is, you see, under the non-current assets, we need to bring another new entrant here. We call it investments in associate. We call it investments in associate. Yes, so when we already bring investments in associate under that statement, under the non-current assets, then it is only prudent that we also adjust our investment figure accordingly. You might get an advantage and it might slip over if the examiner is lenient in a situation where you forget to bring investment in associates here, but again, you also go ahead and forget to, or maybe do not adjust your investment. I hope you are getting that, so that it will balance out. So that the figure that you are supposed to bring here as investment in associate, you've not brought it, but you've clumped it together under investment. And again, you've not adjusted the investment figure by the amount you paid to acquire the associate. So it might slip off, but not easy. It's not always the case. The examiner wants to see, do you know or did you consider what you invested in associate? But even if you leave it under investments, the balance sheet may still balance, but it does not mean you've done the correct treatment. I hope we are getting that. So we need to deduct the amount that we paid to acquire the associate. And again, at the same time, we need to recognize investment in associate. So we've not computed that one, but I want us to check on the statement and see how much did we pay to acquire that associate, because we need to deduct it. Where do we get that information? Let's come to the start of the question. In line number 3, where it's written on 1st of May 2023, that's where we start on the associate issue. So we were told there, on 1st of May 2023, Polo Limited acquired 30% of Allo Limited. So Allo Limited is our associate, Polo Limited is the parent. So it acquired 30% of the Allo Limited's 10 shillings ordinary shares for 35. 10 shillings ordinary shares for 35 shillings per share. So we, again, in this case, the same way we handled the parent, we've not been told if there was any payment in cash. So it seems they also just purchased it using share exchange or purchase of shares. And the price has also been given there. So why don't we go ahead and compute that? So we have a choice. We can compute all that under this. But if somebody might get confused, then I would want us to do the computation of this goodwill on purchase of this associate just beside here, and then we will refer to the amount that was paid as we adjust our investment. So I can remove this negative sign and leave our investment there hanging, but knowing very well, once we've adjusted the amount we paid to acquire the subsidiary, we need also to adjust it by the amount we paid to acquire the associate. So I want us to do that computation, then we will refer and adjust accordingly. I hope you understand that. So this our investment figure is not yet complete. I can also highlight it and leave it in yellow because there is a pending adjustment. So we did a computation of goodwill for our subsidiary. I want us to do for associate. I had even written the word there, associate. So let me just pull it here beside here. Then we start doing for the associate. And of course, when doing again goodwill for the associate, the formula is the same. We start with the purchase consideration. How much did we pay to acquire the associate? Purchase consideration. And purchase consideration there, we go ahead and do it. And when we talk about the purchase consideration, there are always ways in which the parent can pay to acquire whatever percentage from the associate or the subsidiary. The question will guide you. In some cases, you will be told that the parent paid this amount of money and again also purchased this number of shares at this price. In that case, the acquisition is twofold, part of it in cash, part of it in shares. But in this our question here, it is prudent, it is clear that they only acquired it through purchase of shares. So it is only one-sided. So let's go ahead and do it here. Purchase consideration, it was done through ordinary share capital. I just want to write it in short form. I don't want to type the long word there. Then I put an equal sign. Now, how many shares did we acquire from this associate? The percentage, of course, was 30%. I hope we agree to that. We can still refer. Here we were told it acquired 30%. And it is 10 shillings ordinary shares, and it acquired it at what price? 35 per share. 35 per share. So we need to ask ourselves, how many shares did the parent acquire in the associate? To get the number of shares, the same procedure that we had done before, we go to the statement of financial position. Look at the par value, it is 10. Look at the ordinary share capital under Allo, who is the associate. It is 7,200. To get the number of shares, take 7,200, divide by 10. Take 7,200, divide by 10. So I just want to refer to the 7,200 cell. Then you divide by 10 to get the number of shares that we acquired from this associate. Not we acquired, but the number of shares, the total number of shares in the associate. But we did not acquire 100% of the associate. We only acquired how much? We only acquired 30% of that shares. 30%. So it is 30% of the shares of that associate. So the shares of the associate are pegged on the ordinary share capital amount. We divide by 10. What is 10? 10 is the par value per share to get the number of shares. We took 30% of it. Now, this computation is going to give us the number of shares that the parent acquired in the subsidiary. Now, to get the value of those shares, we go ahead and multiply by the price at which it was bought, the price at which the parent bought those shares. I hope we are getting it. Where do we get that price? It was given here. We were told Polo Limited acquired 30% of Alo Limited's 10 shillings ordinary shares. For how much? For 35 shillings per share. For 35 shillings per share. So we come here and multiply by the price. We are multiplying by the price to get the value now. We've gotten the number of shares. Now we are multiplying by 30, which is the selling price or the price at which those shares were purchased. Price per share is 30. Is it 30 or 35? I think it's 35. Yes, 35. Like that. So I just close the bracket and that will give me the total purchase consideration. Members, I hope we are understanding. You know, this kind of an adjustment will always be there. If in case you'll get an examiner, in case Kasneb is going to bring group accounts, they've not brought group accounts for long. In the BDA examinations, if you peruse through and check the previous exams, they've not been very keen on these group accounts. So chances are very high. Chances are very high that they can decide this time around and say, let's throw in a group cash flow question. Let's throw in a group consolidation question. Or let's throw in published accounts question. No one really knows, but this is an area part of the syllabus. They can decide and bring it. If they bring it, you will not miss this kind of an adjustment. And chances will also be very high if they bring this group accounts, they will bring you a situation like this where we have the parent, subsidiary, and associate. They will bring all the three. I tell you, my friends, in case they bring this area, they will not only bring the parent and associate and subsidiary, no, they will bring you a question that has all of them. And this adjustment we are doing here will be mandatory when computing goodwill and acquisition. And the reason why you are computing goodwill and acquisition of the associate is you need to also know the investment in the associate. To know the investment in the associate, you must compute its goodwill. So members, I just hope that we are getting this together. So I will confirm, and we have a value here, and the value I see is 7560. I hope when covering these such critical areas, no one is horizontal, please. It is not time to be horizontal. Do not follow the class while in bed or while in horizontal position. A lot of temptations normally come in from that position. You can doze off and miss this very important concept. All right. So after getting that purchase consideration in the associate, so we ask ourselves, what value did we get when we paid this amount? From the parent perspective now, they paid 7560 million. How much did they get in return? Did we pay more than what we are getting, or did we get a value higher than what we paid? That's where you either get goodwill or bargain purchase. All right, so we check on the net assets of associate. The same procedure that we had done. Net assets of associate. Now, net assets, I remember explaining some very simple concept here, and I related it to what you did in business studies. In primary, in secondary, I think it's Form 1 or Form 2. Nowadays, we call it the competency-based what? I don't know whether it's curriculum or it's learning, something like that. All right. So I told you that we already knew that assets is equal to equity plus liabilities. That simply meant that when you make E the subject of this formula, you realize that E, which represents equity, is equivalent to assets minus liabilities. And assets minus liabilities is what we call net assets. This is what we call net assets when you deduct all liabilities from the assets. So that's why when we are valuing our subsidiary, when we were valuing our subsidiary, we used the equity elements. Why? Because it is the same as net assets. Net assets is assets minus liabilities. So that is the concept we are still following here. We are also getting the net assets of the associate by checking on the equity elements. So when I write net assets and I pick on equity elements, I hope no one now gets confused. This is the concept that we are following. And of course, we already know that. All right, ordinary share capital is one of the equity elements. And where do we get it? The statement was given. We are not required to compute anything. It is here. You see it, the 7,200 which we already used is given there, But then remember, because we do not consolidate the associate, we do not just pick the ordinary share capital, the whole 72 like that. We have to be sure that we only pick the percentage that we own. Members, please take note. Take very keen note. When we were doing the one, when we were picking the net assets or the ordinary share capital of the subsidiary, we picked the figure the way it is in full. You see this? When dealing with subsidiary, we picked 14,400. And of course, that's what was given in the statement. We picked the whole of this. But when we've come now to associate, be sure to only pick the percentage that you own. How much is that? We only own 30% of this share capital. 30%. So just pick what you own. Leave the rest. Just pick what you own. So I hope you'll be sure to remember that because it's very important. If you miss that adjustment, I tell you, your figures will be wrong. So that's what we do. And I'm getting my answer here. I see I have my 2160, which is now representing the ordinary share capital, the percentage that we only have, that we own. We paid 7560, and the net assets that we acquired is the 30% of the ordinary share capital. So I hope you get that. Then the other element of equity, of course, there were two. In fact, this one I can even refer. I just want somebody to see where I'm getting it from. You see, this the other element of equity, revenue reserves, which I've brought here. Now, for the revenue reserves, we go again and pick from the statement given. And the statement given is here. Our revenue reserves for the associate is 16,800. Again, I want you to be very careful here. And you know why I'm talking about being very careful here. I want us to, get something. Now, members, you realize that when we talk about revenue reserves, the examiner gave us some information in note 1. What are the components of revenue reserves? The components of revenue reserves, the other term is retained earnings. When you talk about retained earnings, this is the earnings after you've taken care of all the expenses, the operating expenses. So this profit for the year or profit after tax is normally what is retained and transferred to the statement of changes in equity and clumped together under revenue reserves or retained earnings. I'm seeing some chat here. Somebody saying something. All right, Winnie was saying 30%. Thank you, Winnie. I hope that's what I picked. All right. So now I was saying that when we talk about the revenue reserves, I was just mentioning that you need to be very careful because revenue reserves will always have an element of the profits for the year. The profit that you make for the year, normally you transfer it to the retained earnings in the statement of changes in equity. Now, remember this is an associate. We only own 30% of the associate. And as we own 30% of this associate, we did not trade with the associate for the full year. We are preparing our statements as at. We are preparing our statements. If you look at the required, the position is as at 31st of October 2023. And that is exactly the date at which we have the statements that were given, 31st of October. But we have to do adjustments because we did not trade with this associate for the whole year. We only own 30%, but again, we only traded for 6 months. I hope somebody remembers how we got the 6 months here. But for the subsidiary, we traded together for 2 years. I also believe you know how to arrive at that because you will be alone, my friends, very soon. Time is moving. You need to make sure that you have this concept at your fingertips because you'll do it alone. So you have to know how to get the 2 years for the subsidiary and how we got the 6 months. Remember. And if you have a problem, ask because you'll be assisted right away. So what we do is I've picked on the revenue reserves for the associate. But then we are very aware that we only traded for 6 months. So because profit for the year is part of that revenue reserves, we cannot claim a whole year's profit when we only traded for 6 months. So what do? We only pick the 6 months profit. We take 30% of the 6 months profit. 30% of the 6 months profit. So I start by 30% because that is the percentage of ownership that we have. And it is 30% of the 6 months profit. So the 6 months profit is, I will pick on the revenue reserves, the total revenue reserves, because the profits are part of it. And again, we ask ourselves, were we given the retained earnings or revenue reserves for the associate that started the period? You see, the same way in note 1, we were given the opening. Are you seeing this? Revenue reserves that opened the period we were given. And again, they gave us what was earned during the year. Do we have such kind of a breakdown for the associate? The answer is yes. It is here, Allo Limited. Members, I hope we are seeing that. So in essence, I should not refer to these revenue reserves that is in the statement. I hope somebody is not getting confused. So I should not refer to this. The reason is this 16,800, which is in the statement, contains the balance brought down or the opening retained earnings for the associate. And again, it also has the element of profit for the year. But in our interest is only on the profit for the year. We are not interested in what opened that period. We only have 30%. We are only looking for 30% of what we made together. And we only traded together for 6 months. So I will only be interested in what we made during the year, and it is given here. Retained earnings for the year ended 31st of October 2023. This is what we are interested in, the 7,200 there. So I will go to where we were doing the computation because I know I've clicked on another cell and it's already gone. So where was that? Here, revenue reserves. So these revenue reserves, it is 30% of what we made during the year, what we made together, which is this one here, the 7,200. And the 7,200, we only pick the period we traded together, and that is 6 months. So it is 6 over 12, or you can just multiply by 0.5. Either way, you are still okay. So I can take 6 divided by 12, 6 over 12. We multiply that by the total profit for the year, retained profit for the year, so that we just take a portion of what we made together at 30% for the 6 months. Members, I hope we are together. That will give me the revenue reserves that form part of the net assets of the associate, so that we ask ourselves if we bought it at a profit or if there was some goodwill that we paid. Right. So I hope we are together. Then now from there, is there any other element of equity that we are leaving out on the associate? I don't think so. Those were the only two elements of equity. There was no fair value adjustment the same way we had in our subsidiary. In this note number 6, we were given fair value adjustment only affecting the subsidiary. The associate was not mentioned in this fair value adjustment. So that's why it does not affect our computation or the net assets of the associate. So that gives us the total assets at the date of acquisition, net asset at the date of acquisition. So we can get the figure. I'm using alt equals to give me 3240 like that. So I can go ahead and ask myself, I paid 75.60. What the value that I'm getting back is 32.40. So did I pay more than what I'm getting? The answer is yes. By how much? That difference is what we call goodwill. So I come here and say goodwill on purchase of the associate. Goodwill that we paid was the difference between the amount we paid in purchase consideration versus the value of the net assets that we got back. And that difference is 43.20. That difference is 43.20. So members, I just hope that we are together. Someone will definitely ask, if this is goodwill, if that is goodwill, and this one is also goodwill, why are we not adding this goodwill to this goodwill. I don't know whether somebody asked that question. I don't know whether somebody asked that question. I'm seeing some chat here. A member there, Elo, is saying, what of note number 4? Let's go and check note 4 what it has. What is note 4 having for us? All right. So note number 4 is saying, in October 2023, Polo Limited sold goods to Arlo for 780 million. Very good. These were transferred at a markup of 30% on cost. 2/3 of these goods were still in inventory of Arlo as at 31st of October 2023. That is very good. That is very good. That is very good. Now, that note number 4 is about intra-group trading. Some people call it intra-group trading, or intergroup trading. Now, if there is that intergroup trading, and you see, we were told that it is about Polo. Who is Polo? Polo is the parent. And they sold to who? To Arlo. Arlo is who? Arlo is our associate. Now, parent selling to associate. Parent selling to associate. We call it downstream transaction. Downstream transaction. Now, if it is a downstream transaction from the parent to associate, and we are also aware that we do not consolidate our associate. Now, this UPS, downstream, and realize profit on that downstream transaction, because you do not trade with yourself. You do not trade with yourself. So we are going to do that adjustment. So Elo, do not worry. We've taken note of that. All right. Why are we not using PAP for associate? Thank you, Mercy. Thank you, Mercy. So now, Mercy, we are together. Do not worry. Do not worry. We are yet to compute investment in associate. So do not worry about that. We are yet to compute investment in associate. Yes, we are yet to compute that. So do not worry about the PAP. The reason why, now, when you talk about a share of profit of the associate, that will form part of your investment, because remember, we are not consolidating the associate, but it forms part of your investment. So that's why we are going to compute investment associate and put it at as a separate line, because it is not part of our total investments. That's why I told you, you remember I highlighted this one. Do you know the reason? Is because we need to take off what we paid to acquire the associate. And we only leave the investments line having elements of the parent and associate only. And we treat, we only leave the element of the parent and subsidiary, sorry. Then we put our investment in associate separate. We are not consolidating that associate. So we put it as an investment on its own. Remember that. So I want us now to do that adjustment. I said investments in the group account, the group investments value, we picked the investment value under the parent. We also picked the 100% investment in Solo, which is the subsidiary, and then we subtracted the amount we paid to acquire the subsidiary. Where did we get that? It was here when we were computing our goodwill. So I deducted the 38,880. And I told you, we also go ahead and deduct what we paid to acquire 30% of the associate. Now we already have the figure. You see, now we have the figure. This is where I wanted us to reach. I didn't want to do everything in this cell here, because it would have meant introducing a bracket and doing all these computations we've done here. At this point, somebody might have gotten confused. That's why I left it hanging. So let's now pick it and deduct the amount that we paid to acquire the associate, the 7560. And now that will give us the total investments that we are taking to the statement, consolidated statement of financial position. So I confirm. And now my investments figure is now the 12,480. That should be what is appearing in our statement. Now, after that, having our investment there, now that our investment, we should also remember there was a note that was talking about fair value adjustment. Remember, this figure of investment should only have elements of parent and subsidiary. So anything that affects investment in the subsidiary should be considered. We've picked the total investment of the subsidiary, but again, the examiner went ahead and gave us something. You remember what the examiner gave us? In our computation of goodwill, we already saw it. We took care of it. What was it? Fair value adjustment for the net assets. Here, this one, fair value adjustment of the net assets of the subsidiary. Note number 6, I guess. Yes, note 6. We were told that on November 1st, 2021, Solo Limited owned an investment that had a fair value of 1440 million in excess of its book value. Now, this is part of our investments. We are consolidating 100% of the subsidiary. So this fair value adjustment will also affect our value of investments. I hope you are getting it. So this investment figure, after we've done the adjustments that we've done, we have also to recognize this fair value adjustment that was 1440 in excess of the book value. Yes, and we now go ahead and add, how much is it? I've seen the figure here, it is 1440. So we have also to adjust the 1440. After we've done that, now that's all the adjustments we need to do on our investment line. So remember, we've knocked off the amount we paid to acquire the associate, but the investment in associate, we've not touched on that figure. I know in the balance sheet it was 0, but even if they gave us a figure here, we were not supposed to touch on it. We only pick the parent and this because we come and introduce another line. We call it investment in associate. That is a different line investment. So I want to remove this highlighting because that investment figure, we are done with all the adjustments required. I'm seeing some chart. Yes. Maria is asking, why do we pick 100% of investments in subsidiary? Yet, from the question, only 90% was acquired. Thank you, Maria. Maria, I want you to remember the rules of consolidation. We consolidate 100% of all assets and liabilities of the subsidiary. Who is consolidating? It is the parent. So that is the rule of consolidation. And Maria, I hope you also agree that that is how consolidation has been done. And that's what the IFRSs, direct us to do. So it is because of that why we are taking 100% of all the assets of the parent plus all the assets of the subsidiary. That's why we are doing that. And that's what we've done in all the other assets and liabilities of the subsidiary, 100%. That is the rule. Unless the rule has changed and I'm not aware. Yes, we only have 90% ownership, but in consolidation, you are now one entity. I mentioned something when we started this question yesterday, and I said, when consolidating, the concept behind consolidation is where you are combining the financial statements of a parent and its subsidiary as if they are a single economic entity. That statement underscores all the guidelines that we are following as provided under IFRS 10. Under IFRS 10. So let's remember that. Winnie is asking, what if we add 1440 to PPE? Winnie, when you add 1440 to PPE, remember, even in the financial statement provided, in the balance sheet provided, they treated PPE separate from investments. And in note number 6, they did not mention it is PPE. They mentioned an investment property. I know you are bringing PPE because of the word property written here. All right. Now, if you get a lenient examiner, they might give you that benefit of doubt that because of the word property, now you added 1440, that adjustment, onto the PPE element. But that is not the very correct treatment. Please stick to the investment. Stick to the investment. That's why, investment does not necessarily mean they are fixed assets. That's why normally it comes on its own line. Even if you invest in securities, bonds, and all that, those are investments. They are not fixed assets. So they are not part of even reduction in value or, reduction in value of an investment. Normally, we talk about amortization. reduction in value of that investment property. But when you talk about PPE, it is usually depreciation, constant. So please, let's make sure we check on that treatment. I'm looking at another question here. Rudia, what you added and subtracted. Okay, right. No worries, Liaka. I'm going to do that. Aha, where have you picked 153 and 1440? 1440 was given in note number 6. But 153, I don't even remember that figure. Okay, but let me start on this. 1440 is in note 6. That is the fair value adjustment of the investment. Now, you've asked about 153. That 153 figure sounds very strange to me. Did I type any 153 somewhere? I'm not sure. That's why I'm just checking. I'm not very sure. I've talked about so many things and I'm not sure if where I handled 153. That figure sounds a bit, because our goodwill here was this, our purchase consideration. I talked about fair value adjustment, which was given as 1440 in note 6. I don't know where 153 is coming from. Who is this member? Cherotich, kindly let me know where 153 is. 15,336 was good. Yeah. Oh, okay, goodwill. All right. Wilkista. The goodwill. Okay. Goodwill of the parent. Okay. I guess you are responding to the member. Cell I-53. My cell I-53. This 38. You've forgotten how we computed the purchase consideration, the share exchange, the purchase of shares. Okay, for a member who is understanding what she's asking, please, kindly. She means cell 153. 153, which column? What is the full reference? 153. Hey, I don't know whether I'm understanding what the member is asking. 153 is the number for the row. And here, there is nothing recorded. What do you mean by cell 153? Really?
Manu,
Yes.
in the computation of the investment, you've added the investment in the parent for the parent subsidiary.
Yes.
Then I've
Yeah.
seen something like 153, then you less the one for the associate.
There is no 153. This is a cell reference. This is a cell reference. This is a cell reference. I-53. This is a cell reference to represent this is what I was asking. Did you forget how we did the computation of purchase consideration for the subsidiary?
No. I thought it is 153.
Oh, okay. But now you got it. That's all right. Okay. So where was I? Investment in associate. That's what I was talking about. Investment in associate. So let's go ahead and do the computation of our investment in associate. We already have almost everything we need. But before we compute that investment in associate, I want us to check on note 4. There was a member who told us something about note 4. You see this note 4 here is touching on associate. So I want us to look at it. All right. So note 4 is saying, in October 2023, Polo Limited sold goods to Arlo. Now, we know who is Polo. This is the parent. We know who is Arlo. That is the subsidiary. So, parent sold to subsidiary, goods worth 780. Now, this is a very small working, and I want us to just do it here because it is very interesting and important at the same time. So we want to compute unrealized profit. Remember, there is a rule in consolidation. You eliminate in full any intragroup transactions. You eliminate in full any intragroup sales or intragroup balances. Eliminate in full. Again, you cannot purport to pay dividends to any member of the group. So if there is any intragroup dividends, you must also eliminate in full. So we eliminate all intragroup sales or intragroup transactions and any balances. Remember, when I talk about balances, I mean you cannot claim to owe to be owed by a member of the group. For example, the parent cannot say that there is amount that they they expect to be paid by the subsidiary. Now, this is a member of the group. You cannot owe yourself. You now treat your establishment as one entity. You cannot owe yourself. So those are the intergroup balances. Whether it's the subsidiary who is expecting some payment or receivables from the parent, that must be eliminated in full. So we have to we have to adjust the receivables and payables. That is the full elimination method. Again, intragroup sales, like in this case here, the parent cannot purport to sell to a member of the group and record that sale. That is not recognized. That is not the right way. You cannot sell to yourself. So we want to talk about the unrealized profit. Now, I know we are talking about an associate here, and associate is not a member of the group. That I know very well. That I know very well. Associate is not a member of the group. So when I talk about intragroup transaction eliminate in full, what I mean is a member of the group. But in this case, we are talking about unrealized profit in that downstream transaction. Why do I call it unrealized profit? Is because we've already computed the amount of the profits that we made together as members of in that our investment in that associate. Remember, when doing valuation of this associate, I've picked on revenue reserves and I've told you we prorated to the period that we traded together. So we cannot again purport that there is another profit that we made outside this one, that which we've already recognized. So that's why this other transaction, we will call it unrealized. So we compute unrealized profit in the downstream transaction. The downstream transaction, unrealized profit in the downstream transaction. So what is the downstream transaction? Note 4 is telling us there was some sales. I just write maybe sales or sold because already we've written it is downstream, meaning it is parent to associate. How much is it? We were given the figure. Note 4 is saying it is 780 million. So I will just go and type the 780 million. Then after that, we were told that not all of the goods were sold. Is that the case? We were told something like, these were transferred at a markup of 30% on cost. At a markup of 30% on cost. So if it was transferred at a 30% markup on cost, then we need to ask ourselves, how do we get profit with the markup given? How do we get profit with the markup given? Now, to get the profit with the markup given, and the profit that we are looking at is the unrealized profit. Now, how do you convert markup to margin? I want you to start thinking of that. And as you do that, I'm continuing to read that note 4. And they said 2/3 of these goods were still in the inventory of the associate as at 31st of October. 2/3. 2/3 were still there. So when you talk about 2/3 that were still in stock, it is the 2/3 of what was sold. 2/3 of what was sold. So I will come here and say that remaining in stock is 2/3. 2/3 of what? 2/3 of what was sold. So what was sold was 780, like that. So 520 million worth of goods were still remaining. So the difference of what was sold and what was remaining will represent technically the amount that they must have sold. So what does it represent? The difference is 780 minus 520. So technically 260 is what was sold. It was what the parent sold to the associate. And this is the value where that has that profit element. You see the 260? It is that 260 that has the profit element in it. That has the profit element in it. But remember, I want us to just, twist that argument a little bit. You know why? We are dealing with an associate. And when dealing with an associate, it becomes a little different when dealing with the subsidiary. So you see the 260 that I've gotten here, the difference between the amount that was sold and the remaining in stock. I want to do away with it. Do you know the reason why? I hope you understand the reason why. If you don't understand, just don't worry, just hold it on. This is what was sold. This is what was remaining in stock. When you talk about unrealized profit on an associate is not a member of the group. So actually an associate will be treated as a third party. Any sales the parent does to associate should be valid because this is not a member of the group. The element of unrealized profit only comes in on the goods that are remaining unsold in the associate. How much is remaining unsold? It is 520. That is where the element of unrealized profit should come in. Now, how much profit is in the 520 that remained unsold? How much was the unrealized profit that remained in the unsold stock? How much is the unsold stock? The 520. So how much profit is in that 520? That's what we need to compute. So that profit that is in this 520 is the unrealized profit. The profit that is in the 520 goods remaining, that is the unrealized profit. Why am I talking about profit? We were told there was a profit margin, there was a markup that was given in those goods. And note 4 is clearly telling us these goods were transferred at a markup of 30% on cost. So this 30% is the markup. So let us get the unrealized profit in those goods remaining. And the unrealized profit is at a markup of 30%. Now, when it is 30%, how do you convert markup to margin? Somebody remind us. There is a shortcut here, but I just want somebody, we just need to get all the perspectives. All the perspectives. Yes, Elo is giving us the shortcut. Thank you, Elo. I was just wishing if someone can understand how we are using the 30 over 130. Uh-huh. Uh-huh. I just hope someone understands. I just hope. When converting markup to margin, yes, I see the members there. Elo and Winnie are giving us that. All right. Profit margin is always on sales. That's very correct. Thank you, Elo. Thank you. Yes, it is A over A plus B. Very simple concept. A over A plus B. So if this is 30%, 30% represents A. Yes, 30%. 30% simply means 30 over 100. So if it is 30 over 100, now it is A over 100%, A plus B, 100% plus the numerator. So it will be 30% over 100 plus 30, like that. So that's where we are getting, that's why the members there are giving that by saying it is now 30 divided by 130, like that. That is the conversion of markup to margin. Margin is always higher, it's always bigger than the markup. So that's the reason for adding the numerator to the denominator. I hope that is a simple logic that we understand. So I just remove it and come here and say, in that case, once we've agreed, now we are using the 30 over 130, 30 divided by 130. Then we multiply that by the amount of goods that are remaining unsold, because that is where the element of unrealized profit is. And that gives me unrealized profit of 120. Yes, now, after I have this unrealized profit of 120, now I come and do my computation. I do my computation of investment in associate because I will need this figure. You see this figure? I need it when looking at investment in associate, which I just want to do down here, investment in associate. Investment in associate. You see, these questions are normally quite long, and you just need to make sure you know the concepts, because if you do not, you might, really struggle to find your way through, especially those things that we are computing: investment associate, the investments itself, goodwill, and these are the two notorious fellows: group retained earnings and NCI. Very stubborn, and you have to really be careful with them. You have to be really careful. But in case you are not able to remember the concept, make sure you maximize all the entries. Do all the others, and you'll still be able to score almost everything, very good marks, even if you do not have time, or maybe you do not remember how to complete them. But you need to know them. That's why we are doing them here. Now, Investment in associate. Investment in associate is now the total of, you see the 30% that we have in associate, we want to get its total value, And we start by what we paid to acquire the 30%. So we start by cost of investment. Or sometimes you can call it purchase consideration. We already have it here. You see it here. We already computed the 7560. That's what I'm talking about. Then after we check on what we paid to acquire, we ask ourselves, what was the share of profits? What was the share of profits that we get, that we got from this, from this investment of ours? What share of profit did we get from the share of profit? Now, up here, we already computed the share of profit. Now, did you see this? You see these revenue reserves? You remember how we computed this? We took 30% of the profit we made together in the 6 months, and the profit that we made together, we took that 30% of this for 6 months of the profit we made together. Where did we get the profit we made together? It was given in note 1. This retained earnings for the year. This is what we made with the associate. So we took 30% of it, but we also are aware it was not for the whole year, 6 months. So 6 over 12. I told you, you can take half or 0.5. It is still the same thing, 6 over 12. So I hope you remember that. And we are picking the same figure because we already did it. That's why I'm not repeating. I'm just picking and saying add, share. I'm not using post-acquisition. Like there was a member there who was saying, why are we not picking post-acquisition? We did not acquire associate. This is just an investment. So I just say share of profit. I will not call it post-acquisition. We did not acquire. So I refer to the 1080 and I hope you remember how we've computed it. I've just reviewed it here. But if in case someone is still floating, make sure that we are together. Then from there, we ask ourselves, what else will affect our investment in this associate? What else affected our investment in this associate? Remember, we've already shared the profits that we made. You see this profit, the way we computed it, we picked on this. You see this one here? We picked on this. We picked on the profit we made for the year. But in that profit made for the year, because this is an associate to us, there were some goods that we sold to them. There was a downstream transaction, but not all of it was sold. You remember that? This is what we've just done here, just a few minutes ago. The UPS that on the goods that were remaining. So that UPS on the goods that were remaining, that amount of UPS, we also have to take care of it. We deduct it from our value of investment because it was already captured in the profit for the year. So we have to adjust our profit for the year. You see the share of profit for the year, we have to adjust it by the unrealized portion of it. We have to adjust it by the unrealized portion of it by saying less UPS, unrealized profit. We can still even write downstream. There is no problem. But even if you write unrealized profit, so long as you know which profit are we talking about. Now, when we are adjusting the unrealized profit, I'm putting a negative because we are correcting this profit here. I'm putting a negative, we deduct. Now, when we are adjusting that share of profit, make sure that you only take your 30%. This is the whole unrealized profit for the whole thing, for the whole amount of remaining goods. But remember, you are only claiming 30% of it. This is not a subsidiary. So do not assume 100%. So we are only taking the unrealized profit, but 30% of it, 30% of that 120, 30% of the 120 is what we are claiming. So that 30% of 120 is coming to 36. So that is what we are correcting the share of profit with. So that will give us our total investment. Is there something that we are forgetting that we need to adjust? Let me just check. So note 4, I think we are done. Note 5 is talking about some license thing. This does not touch on the associate. This was about solo. That is the subsidiary. I think note 3 was talking about a check that was pending. I think we are coming to this after what we are doing. And this is not talking about associate. That is also subsidiary. So I think for associate, we are done. So let's just get the total investment in associate like that. And then I use my alt equals and get my figure here. Now this represents investment in associates, and I'm getting 8604. So that 8604, it's coming to our statement here. That's what I'm bringing on board under investment is associate, and I want to refer to it. I refer to it like that. Good. So that one is done. So non-current asset section is in full. I'm seeing some charts. Share of UPS. Yes, share of UPS we've done. Highlight for me everything needed to calculate. Winnie, what do you mean? To calculate what? INV in us. Hey, Winnie, I don't understand what you're saying. Pardon UPS in the investment in associate. All right. All right. All right. Perez and Winnie. Okay, so the UPS in the investment associate, where is it? Let me just go there. UPS is here. Now, remember, UPS stands for unrealized profit on sales. Unrealized profit on sales. We call it downstream because it is the parent selling to associate. We know why the relationship is like that. Now, the parent sold goods worth 780. But we've been told in note 4 that out of all the goods sold at a tune of 780, there were part of it that were not sold. Part of the goods were remaining in stock. And the goods that were remaining in stock were 2/3. So we computed 2/3 of that value that was sold, and we realized that the goods that were remaining in stock was worth 520. Now, after that, we ask ourselves, what portion of profit, what amount of profit is in those goods that have not been sold? Remember, we were told that these goods were transferred at a markup of, we were given the percentage, at a markup of 30% on cost. So that markup already is in those goods. So those goods that have been that are remaining here, they already have the profit element, the markup element in them. That's how we converted the markup given to margin to get the profit margin. That's how we got the UPS by taking 30 over 130. You remember the computation that I've just done? Converting markup to margin means you take the numerator, you add to denominator. 30% that we were given, we added to 100%. That's why we have 30 over 130. Then we multiply by what? By the goods that were remaining, so that we get the profit element that was not realized in the goods in stock. Profit element that was not realized in the goods that remained in stock. That's how we got the total UPS of 120. But then this UPS of 120 is the total in full of the profit on all those goods sold and the goods that remained of 520. When computing our investment in associate, we add the profit, share of profit, which I believe none of us has a problem with. Then when we come to deduct or correct that profit, we have to recognize that profit was already captured in the 1080. You see, this profit for the year that is given in note 1, this amount of 7,200, the element of the profit on those goods that were sold is already captured in that profit. Now, because we've realized there is some profit that was not realized, we come and now adjust. How do we adjust? We take 30% of the total unrealized profit because we only claim 30% of that. So 30% of the total unrealized profit, that's how we got the UPS to deduct or to correct our profit with. I hope someone gets something. I just hope. Caro is saying, if I use A over B plus A, I'm getting a different thing. Caro, I will not use A over B plus A. I will take a very, very simple approach. You are given a markup. You are given a markup. The markup you are given was 30%. Now, you are supposed to convert markup to margin. When you talk about markup to margin, we know the formulas. Markup is normally gross profit over cost of sales. I just remember, I think if I'm wrong, you remind me. Markup gross profit over cost of sales, but margin is gross profit over sales, like that. So because of that, it tells you between cost of sales and sales, which one is higher? Obviously, sales is normally higher than the cost of sales. Yeah, so that is something that I believe we all agree. Now, because of that simple logic, when converting markup to margin, you should know that margin is higher or greater than markup. So when converting, you add the numerator to denominator. But when doing vice versa, margin to markup, you deduct the numerator. Now, if markup is 30%, it simply means markup is 30 over 100. I hope we are getting it. Markup is 30 over 100. So if you are adding numerator to denominator, what do you get if you add 30 to 100? See, it is 130. So that's why our margin is 30 over 130. You are just adding the numerator, which is 30, to the denominator of 100. That's why we are getting 130. But you retain the numerator. So that is the simple logic. So I hope the person who was asking, I forgot the name. I hope, Caro, you now have it. Members, I hope we are together. Investment associate, we are done. Now, there is this note number 3. Is it 3 or 2? That we've not tackled. I think it's one of the notes. We only have 2 notes that we've not checked on. Note number 5 and note number 3. So let's look at note number 3. It's a very interesting one. This one does not even require a lot. Note number 3 does not require much. It is all about, they're telling us there was some transactions and there was some money that has not been received by somebody. So let's get to see what is this money that has not been received and how do we do the adjustment? That is what we're supposed to check. Now, I want to read it. A check of 480 million from Solo Limited. Who is Solo? Solo is the subsidiary. To Polo Limited. Who is Polo? The parent. So there was a check written by the subsidiary to pay or to settle some amount with the parent. But this check was not received until 3rd of November 2023. When is 3rd of November compared to the date of reporting? Our date of reporting is 31st of October. So meaning it was received 3 days later. Yes? So by the time the statements were being prepared, the check had not arrived. But on the side of the subsidiary, they had paid. Yes, they had paid, but the check was still in motion. We call it cash in transit. Cash in transit. You can call it check in transit if you want, but check is simply just cash. It falls under cash in transit. So this money was received 3 days later. So intercompany balances are included in the accounts receivables and payables. Now you see what I was talking about. I was talking about intergroup balances should be eliminated in full. So we have to eliminate receivables and we also have to eliminate payables. We have to correct these ones. Both on receivables and on payables. So we have to go and see and check on this. Now, there are 2 ways you can handle this question. Do you know the ways? I want to start with the first one. The first way to handle this question is to come to our statement of financial position and say that because we have some money that has not been received, it is money that is in transit. I can come here and say cash in transit. Who is consolidating? It is the parent. Did the parent receive the money by the time they were preparing statements? The answer is no. So to them, who is the parent who are consolidating, there is some money which is in transit. How much is it? 480 million. That is the first thing that I will do. Then, again, as the parent, you ask yourself, do you still expect some payment from the subsidiary? The answer was yes. Because we were told that they were included in the balances. Of the companies, that is the payables and the receivables. But remember, we added all the assets and liabilities of the subsidiary onto the ones for the parent. So as we adjust, we need to eliminate in full. Now, on the receivables, the amount we expect to receive, ideally, we need to deduct the amount that we expect to receive. That is 480. That is the other way I was talking about. Now, this is one way. I've just recognized 480, but we know that in the receivables, let me highlight receivables and highlight payables. You see these receivables and payables? Because receivables for the subsidiary is here and receivables of the parent is here. So for the parent, they expect 480, which is included here. And in the subsidiary, in their payables, that is the people they owed, they have the 480 included here. So that's why I normally take the simpler route of saying that let us eliminate them in full if there is any intragroup owings. But I want us to read between the lines on how they gave this statement. They said that intercompany balances are included in the accounts receivables and payables as appropriate. I have a question from that statement. My question, from your understanding, do you believe that in the receivables, the parent had the 480 and in the subsidiary, their statements had the 480 they were supposed to pay? Let's start from there. Do you believe that they were already captured, the 480, by the subsidiary and by the parent? Do you believe that that is the case? Ignore what I've written here. You see the 480 that I've put in that cash in transit. I want you to just ignore it. Let me highlight it using a different color. Yes. Now, my question, do you believe that the parent had the 480 in their receivables, the amount they expect? And do you believe that the subsidiary included the 480 in their payables, their liabilities? We start from there. Very good, very good, very good. Aha. Elo is saying, why issue check, then not capture it, deduct it from payables? Okay, Elo, I agree with you. Aha. Nicholas is saying, my assumption is the 480 had already been deducted from payables. Okay. Okay. All right. All right. I think we have two categories of people here. I'm off. Okay. Okay, Chris will share the workings. And you're going to work a bit early. It's all about 6:25. Okay, no worries, no worries. We'll share the workings. So it's okay, Chris. Aha. I see we have most members are agreeing that the balances are already there in the figures. Though there is a member who is saying that the balances had already been deducted. The 480 had already been deducted. Now, members, from the additional information that has been given in note number 3, they said very well that the check had not been received. Now, let us all take ourselves to the date when the preparation of the statements was happening. And the statement that were prepared, it is both for the parent and the subsidiary. Both of them prepared the statements at the same date. Now, on that date, Solo, who is the subsidiary, had not paid. The check had not reached the parent. You know what that means? You know what that means? According to Solo, they had paid. Do we agree? I know this part normally confuses people. Do you agree that according to Solo, at the time they were preparing the statement, they had paid? Do you agree with that? Very good, very good, very good. According to Solo, they had paid. But according to Polo, who is the parent, at the date of preparation, had they received the money? The answer is no, right? They had not received it. So it is twofold. Solo already knew they had paid. How do we know that they had paid? In note 3, they said it was not received, but already it was paid. Meaning, according to the statements in the books of the subsidiary, they did not have a liability. They did not have a liability. But according to the parent, they had not received the money, they received it later. So it is not affecting both sides. So payables, who records the payables? It is the subsidiary. So we do not affect the payables figure. Do we agree? Do we agree that our payables figure from the subsidiary, we are not affecting it because they already paid according to them? So we are not touching on that. Do we agree? Correct. Correct. So I remove this highlighting of the liabilities. I remove the highlighting. I hope you are understanding why I'm doing that. So we are not affecting our liability because according to Solo, they had paid. But according to the parent, they had not received the money. So if they had not received the money, what happens? If they had not received the money, my question is, do you think they were still claiming that value in their receivables figure, in the balance sheet? Or did they still record it in their receivables because they had not received it? Good. The answer is yes. It was in their receivables. It was in their receivables. Very good. So if it was in their receivables by the end of the year, because they had not actually received it. Now, in this hour adjustment, I have said, I have recognized that there is some cash that is coming in transit. So there are two ways. I started by saying that two ways you can treat this. This is one of the ways. Now, if they had already recorded it in their receivables, then it means their receivables figure was overcasted. The receivables figure of the parent was overcasted by 480 because already they should have received the money. So to correct these receivables, we could have taken the 9720, we deduct 480. Then we say, now we have corrected our receivables figure. You see that? That is one, so that you get the correct one. Again, you can do that, or you simply go and recognize the amount that is in transit and it will balance off the effect. Remember, when you add 480, here is where we are adding. We are adding 480 and we deduct the 480 from the receivables. The net effect is zero. Do we agree? The net effect is zero. Do we agree? If we add and deduct the same amount, it will be zero. So we have to effect it on one side. If we are adding, we should not deduct. If we are deducting, we should not add. Members, are we together? So we choose which side. You have two choices here. My first choice, I remain with it by recognizing the cash in transit, and I'm not coming to deduct again because the net effect will be zero. Do we agree? Correct? Correct. So we add the cash in transit, and that is what balances off the equation. So that is all the adjustment you're supposed to do at that point. Yes, so we are not touching again on the receivables because we have opted to add. We have opted to add this cash in transit. I know someone would want to add it under receivables. You can come and add it here. I know someone would want to add it here. The net effect will still be the same. But I feel the most appropriate way is to include another line for cash in transit. Yes. So I believe, members, we are together. There are people who have floated, that is Eileen and Mawia, they have floated. So where do I start from now? Now, I want to make it simple for Mawia and this other member called Eileen. Now, what we've done is very simple. From the statement given, the statements were prepared as of 31st of October 2023. The payment that was done by the subsidiary was not received until 3rd of November. When is 3rd? It is 3 days later after preparation of the statements. Now, I started by asking you, the subsidiary, because they're the people who are supposed to pay the 480, according to them, did they pay the 480 in good time or they did not? Members agreed. that they paid the money. Meaning, in their payables figure, they did not have 480 as the amount that they owe to anybody. They had paid it. That's why we did not touch on our payables, because we know payables of the subsidiary is here 100%. So we did not touch on it because according to the subsidiary, they had paid 480. The only problem is this money is hanging somewhere. And that's why the parent has not received it. According to the books of the parent, by the time they were preparing the statements, they still expected to receive this money from the subsidiary. So they must have included it in their receivables. Receivables in their debtors figure, they must have included it because they had not received it. But according to the subsidiary, they did not include it in the payables because they had paid. The only problem is the money was still hanging somewhere. Now, on the side of the parent, they expect the payment. On the side of the subsidiary, they think they had paid. Now, the money comes in 3 days later. What adjustment do we do? The adjustment is very simple. The only thing we are affecting is the receivables, what the parent expects to receive. Because that money they expect to receive was already paid. The only thing is they got it at a wrong time. So what we do is, there are two ways. We can now deduct the receivables figure, deduct the 480 because it is no longer a receivable. The money is already there. It's no longer a receivable. That will correct the statement because it overcasts their debtors. It overcasts their receivables for no reason. The money is not a debt. It was paid. Or we can leave our receivables figure like that and say we recognize the money that is on transit. If we correct it in both ends, if we say that we are reducing our trade receivables by 480, we will deduct 480. Then we are also recognizing the money that is in transit by adding 480, this one here, the net effect will be 0. I hope you agree. The net effect will be 0. But this money that is in transit is supposed to come in. It is money that is supposed to come in. So we have to decide if we deduct the receivables, we correct it by deducting the 480, we will not come and again recognize this here. We have to make sure we do it on one side so that the net effect is 480. So the prudent way that I've chosen on is, let's recognize the cash in transit, the money that is coming in like that. And once we've done that, we are good. I hope the two members have gotten something out of that. So I will remove the highlighting. What else is remaining in our statement? The two notorious fellows, the two notorious elements, this NCI and group retained earnings. I told you, members, in this case, you do not have to scratch your head so hard by doing all the two computations. But for us, we should know how to do them. Even though in an exam, you don't have to stress yourself so hard. Now, I want to start with the easy one. Which is the easy one? The easy one is the NCI. The NCI at reporting. Do you know why it is easy? It is easy because we already have almost everything we need. We have everything that we need. And the things that we need, I will take you back to the computation of goodwill that we did. Where was it? You see the computation of goodwill? Then in the computation of goodwill, we shared out some profit. You see this profit that we shared out. Now, this sharing out of this profit, post-acquisition profit, now it is the time we need it. I told you we need these computations for both the retained earnings and NCI. So I want us to do the easy one first. Let's do NCI. So I want to do NCI at reporting. NCI at reporting. This is now very easy. Members, what is remaining is now very easy. We have everything. We're just joining them together. We're just joining. So even for those who are preparing to go to work, don't worry. Whatever is remaining is less than 5 minutes computation. So in fact, you'll not even lose a lot. So here, under the retained earnings for NCI, we start by picking the fair value of NCI. That was also given by the examiner. That one, again, we are not computing because it was given. Fair value of NCI. And it is the fair value of NCI at the date of acquisition. when this acquisition was done, because that is when the NCI was also realized. So the fair value of NCI, what was already given, and we already used it here. You see the 3,600, it was given in note number 1. Is it note 1 or note 2? It was in note 2. And I believe you remember where we got it here, note 2, the 3,600. That is what we pick first. Then onto it, we just add the profit, share of profit to the minority shareholders. Share of post-acquisition profit. Just a second, members. All right. Sorry for that. Sorry. So I was talking about the share of post-acquisition profit. This one also we already did the computation. So that's why I was talking about where we computed goodwill. You see that place? We already shared out the profit. Where is it? NCI share of post-acquisition profit. That is the profit I'm talking about. We pick it. My friends, this is all we need to get our NCI at reporting. There is nothing much here. If there was impairment of goodwill, then because we used a full goodwill method, then we would also make sure that that adjustment could have been done accordingly. You see, we did share of goodwill, right? Now, this share of goodwill at acquisition between the parent and NCI, we are going to use it in the computation of retained earnings at reporting. So if there was impairment, it would affect these figures here. But in the computation of NCI at reporting, we do not need to worry about that impairment at this stage because we are not bringing goodwill here. What we are bringing is share of PAP, post-acquisition profit. So the net effect of this, we just add the two, and I'm getting the retained earnings there as 5280. And without wasting time, I just go and pick and bring in the NCI that we've computed. This figure here, I bring it there. Now, once you reach this stage, you have two choices. You can just get the balancing figure, or we can also go ahead and compute the retained earnings and see if they will balance out. I want you to try it on your end to see if our figures will still be correct. So up to this point, we have the total of assets here, and I think we've computed all assets. We have now total liabilities and equity, but now the balancing figure, which is the difference between total assets and total equity and liabilities except retained earnings. So that difference will be the value for retained earnings. How much is it? I'm getting 104. I'm getting 100 and what is the difference? Where is it? 104. No, is it really 104? Let me see. Is there something that we are leaving out? Non-current liabilities, it is there. Trade payables, current tax, overdraft. Okay. Is there something we are leaving out? If we are leaving out something, members, you just talk about it. Make sure that I'm correct. Make sure that I'm not leaving out something. Make sure I'm not leaving out something, but I feel I'm leaving out something under equity. You see, under equity, my question is, do you think that the ordinary share capital figure, where did we pick it from? We picked the one for the parent, right? Correct, good. No, so we picked the ordinary share capital of the parent, and we said that is according to the provisions in the IFRSs. But my question is, do you remember that when we were buying the subsidiary, it was purchase of the shares? Do you remember that? We purchased them in form of shares. Do you see how the question started? We acquired 90% of ordinary shares of 10 shillings per value in solo, and we paid 30% per share. So my question is, don't you think that our share capital base was affected by that transaction? We again purchased more shares from our associate. Don't you think the share purchases do not affect our equity share capital? Don't you think so? Lean share premium, yes, share premium is there, but it still falls under ordinary share capital. So I'm just asking, do we have the impact of that share purchase on our equity base? Or do we assume it? Do we have the effect? Yes, Win is agreeing. Do we have the effect, members? We are 48 members. And so far, there are a lot of good members who are just not, who are very quiet. They're not telling us what they feel. We need those brilliant ideas, fellows. All right, I give them time to think. Now, do you know how we are going to test on that? It is very simple, very, very simple. As you think whether it should have an effect, Gladys is also agreeing. As even the other members are still trying to weigh options, I want to give you the way to compute retained earnings, the group retained earnings, because that will also inform you of the figure. Because already I told you, we're just going to get the balancing figure. You see this balancing figure, 104,244. That's what should come here. And then our balance sheet is balanced. I will balance and we are done with that. But I just want to confirm. How do I confirm? By computing group retained earnings. How do we compute group retained earnings? Members, how do we compute group retained earnings? So we will take retained earnings of the parent, and then onto the retained earnings of the parent, because the parent is the one consolidating. So we have to take its retained earnings. Then we will add what they shared from the post-acquisition, share of post-acquisition profit. Remember, the parent has their share, 90%. The profit they shared, we've computed NCI using their share. Now we also do the same for the parent because it's the parent who is consolidating. Then after that, we also add what again the parent shared from the investment in associate, share of profit. This one we don't call it post-acquisition because you don't acquire the associate. Share of profit from associate. This is an investment. There is a profit that you have to share into using the 30%. You remember what we already did? I think I did it here. Yes, share of profit. You see this one? We already shared a profit of 1080. That profit that we already did here, that is the share that we have to recognize when we do the group retained earnings. Then we also say that if there is any impairment loss from the investment, any impairment, if our investment is impaired in any way, we will less it. Less impairment loss, because that is the reduction in value of our investments. Then what else? What else do we normally, again, good. When the parent sells to the associate or to the subsidiary, if we have any UPS, but here I'm not talking about associate because we don't consider associate. It is now there's the subsidiary, UPS downstream. But remember, it only touches on downstream of the subsidiary. Do not bring anything to do with associate here. This is a consolidated statement. Associate downstream, we are done with it. So it is just subsidiary alone. I think that is all the adjustments. If I'm forgetting something, members, you remind me. I think we've already share of profit in associate. if there is impairment, if there is any UPS on the subsidiary, yes. I think that's all. If there is something I'm leaving out, we'll slot it in, but for now, we'll just go and continue. Now, retained earnings of the parent. Remember, we are picking the retained earnings of the parent at the end of the year. At the end of the year. Where do you get that information? That information is given in note 1. Retained earnings for the year ended 31st of October. How much is it? 15,600. That is the retained earnings that we pick. And then we add any share of post-acquisition profit. Let's check our computation of goodwill. We shared the post-acquisition. You see, we already used the one for NCI, so we are using the one for the parent. This is the profit. Now you see the reason why I brought this thing at this stage. It is helping us. So we don't have to do a lot of computation, just transferring figures. So I bring it there. Then we add share of profit from associate. Where did we get the goodwill, computation of goodwill of associate? Very good, very good, very good. Share of profit from associate. Now, we added share of profit from associate, and it was what? It was 1080. Remember when computing investment? So that 1080 is what, again, we are picking there. Then, was there any impairment loss? I don't remember seeing any impairment loss. There was just a fair value adjustment on the investment. There was no impairment loss. So that is okay. Then, was there any UPS downstream on subsidiary? No. UPS that was there was for associate. So subsidiary, no. So that is all the adjustments, I believe. And that should give us the total net effect. And I'm getting a very interesting figure there. Very interesting. Very interesting. And now, I think now you have seen the question that I was asking. You will see that now it will be valid. It will be valid. So members, tell me, is there something I'm leaving out here in the computation of this? Let me see here. Are there any charts? There are no charts. People are so quiet. What's happening? People are quiet. Have you given up already along the way in the computation? Have you given up already? Have you given up, members? I want us to finish. I know there are people who now want now to exit and go to work. We left at a point where I saw Winnie, Gladys, and Eileen, who are saying we have to recognize the share purchases. Let me see, somebody else is saying something. Why have you used 15,600 instead of 87? Okay, let me see. 15,600, where did I use it? 15,600. Okay. Thank you. In fact, you are very right. You see, this retained earnings. Oh, I picked on this instead of the final. Oh, sorry. I think we need to pick. Who was that? Thank you. That is a very good reminder. This is Nicholas. Thank you, Kibe. Kibe, that's a very, very good note. You noted something very good there. We need to pick the closing retained earnings, which is this one. That is what we need to pick, the closing retained earnings. Yes. I hope I've picked the correct share of post-acquisition profit. Let me just check. Correct. I think I've picked the correct one. What else? Is there anybody saying something? No. Okay. So with that, let me see. So what is our group retained earnings from the computation? It is coming to 103,800. Share of profit from associate, I hope we computed it correctly. So if it is 103,800 and this balancing figure that was coming here was how much? Let me see. This was 104,244. Very nice. This is very good. This is very good because there is some difference of 444, and we are not allowed to do guesswork. So either side, we really have to be careful and know if there is something we are leaving out, or we picked a wrong figure here, or we pick the balancing figure. Now, under ordinary share capital, I said I still feel strongly that we need to recognize the share capital, that the shares that we bought when we purchased the subsidiary and the ones we brought on board when we purchased the associate. I know share premium is there. So you can also decide to introduce another line for share premium, or even if you lump it up under share capital, you'll still be okay. I think no one will be able to penalize you. So I can go ahead and pick on the share that we purchased, or from the subsidiary. How much was it? 38,880. You see that? And then I can go ahead and also take the ones that we purchased from the associate, like that. Yeah, we are preparing the final statement of the parents' books as a group. And as a group, I know associate is not a member of the group. But when you talk about share, when you talk about the purchase of shares, we purchased 30% portion. So that 30% portion, the only fair thing to do is we need to recognize it. We need to recognize it. So as we recognize it, we have to pick on that value. So is there anything else affecting ordinary share capital account? I think there is no any other element. So that brings it to 106,440. And then our retained earnings, which now becomes the balancing figure, comes to 57,804. So I told you, I will not really scratch my head so hard. I will just want to pick that balancing figure and put it there. And because that is cross-reference error, because I cannot refer to the same element that brought that difference, I need to bring it like that. Then I paste it as a value like that. And that should really balance off my books like that. But I want to ask you that why do you think that the one we've computed using this here, the retained earnings here, is different from what we are getting as the balancing figure? Tell me the difference. Try it on your end, and we see what of note 5. Okay. Oh, thank you, Elo. There is note 5 somewhere. Let's see. Let us see what note 5 has for us. Note 5. Note 5 is saying, just prior to its acquisition, Solo was successful in applying for a 6-year license to dispose of waste products. The license was granted by the county government at no cost. At no cost. So, did anyone spend anything? The answer is no. So, Solo, who is the subsidiary, did they spend money? Did they purchase anything? The answer is no. But, however, Solo Limited estimated that the license was worth 2160 million at the date of acquisition. Members, do we think that the 2160, the cost of that license, would affect the value of net assets of the subsidiary at the date of acquisition? Do you think it will affect the value of the subsidiary at the date of acquisition? I want your input there. Do you think it will affect the value of the assets, net assets of the subsidiary at the date of acquisition? Do you think so? Because from my end, I don't think it has an effect, because we've already been told, yes, they applied for a license. Remember, a license is not an asset. Is a license an asset? It is not an asset. So, however much they mentioned profoundly that at the date of acquisition, they were doing this intentionally. They started by prior to acquisition. They really wanted to stress the word acquisition. Then again, at the end, they also repeat at the date of acquisition. But now, our interest with the subsidiary at the date of acquisition is really their net assets. So, if they could have spent, then it could have been an expense to them. It could have been an expense, meaning being an expense will only affect the profit for the year. It is not going to affect our balance sheet. It could have been affected here. You see this point where we have retained earnings for the year, then the one for the solo, the subsidiary, could have been affected by that expense. But in this our case, I'm seeing some charts here. Okay, you are saying no, expense. Correct, Wilkista. It could have been an expense, but it is not really an expense because they did not spend. They did not spend. So members, let's agree. Whenever you get to an exam and you get such a question, and I've told you, examiners have not brought this area for long. Chances are high they might. No one knows. They might bring, and in case you meet such a question, do not waste time. Do the entries very fast, do the consolidation, and when you come to adjustments, do the necessary adjustments of goodwill, investment in associate, then make sure that investments itself, you also take care of it properly the way we did. Then when you come to these two notorious fellows, I call them notorious because they're normally very stubborn. Group retained earnings and NCI at reporting. Choose the easier one. Mostly the NCI at reporting is normally easy. Do it. The other one, let it be the balancing figure. Remember, in group accounts, each entry should give you 2 marks. Only if you get a mean examiner, that would allocate 1 mark each. But each entry should give you 2 marks, meaning what? You might end up scoring full marks of 20 without you computing group retained earnings, without you computing NCI, or again, without you doing investment associate, you might still end up getting full marks. So there is really nothing to worry about. So just make sure that the other obvious adjustments and computations